Hello, Matthew Copley with Copley Financial Group, and today we're going to do a market update. It's been quite a while since I've done a market update, and the reason is I was out of town for quite some time on our 21st wedding anniversary, and so we went to Japan, spent some time in Tokyo, Kyoto, up by Mount Fuji. Really nice time. Highly recommend it. Great time to visit. The yen has dropped in value against the US dollar, so we were able to stay in places for a lot less money than it would have been in the past. So enough about Japan. I have been trying to get caught up here, so that's one of the reasons for the delay. And the markets were doing fairly well while I was gone, and a few weeks after I got back. We have had a big steep pullback in the markets just in the last week and a half, and I'm not too worried about it. We're still way up on the year, and we're not doing nearly as bad as everyone else. We have an overweight position in gold and oil. Both of those have been performing very well in this environment. And essentially what's happened is inflation numbers are coming in much worse than all the analysts had expected. And so we were prepared for this, and we positioned ourselves in the right way. I still don't think Wall Street and the analysts quite get it, that inflation is going to be a lot worse. They're still pricing in rate cuts this year, which may happen. Oftentimes the Federal Reserve does not want to disappoint Wall Street, so they may cut once or twice just to do what they say what they said they were going to do. And that may happen sometime later this year. So I think it's pouring gasoline on an inflation fire. I think you're going to see inflation probably continue to ramp back up. Deficits matter, and when the government's spending this kind of money over and above what they're taking in taxes, the result is going to be inflation. So we're going to continue doing the same thing we've been doing, a lot of inflation hedges, taking advantage of these high interest rates, which are still available. The buffered index is fantastic. It's got a 23.1 cap with a 20% insurance buffer on it, the one we have available now. We'll have some new ones available in probably early to mid-May, so we'll be able to do another one of these market updates relatively soon and go over those numbers. The barrier product is fantastic. That is a 5-year buffered index, so you have to be willing to put your money away for 5 years. But that particular one has a 200% participation rate on the stock market, on the S&P 500. So if the market is up over 5 years 50%, you actually are up 100%. If the market's up 100%, you're up 200%. So it's really a fantastic product. And if the market's down any amount between 0 and 50, you don't lose any money. You actually get your money back. Of course, there is one catch. If the market is down more than 50% 5 years from now, you would take the full loss. And so if the market was down 60 or 70%, you would be down 60 or 70% because that 50% barrier is there just down to 50. I think the likelihood of the stock market going down more than 50% over the next 5 years is zero. I don't think it's going to happen. I don't think it would ever happen in an environment, especially a fiat currency environment. If the market was down 50%, the government would put in all kinds of stimulus and push it right back up. So I'm not worried about losses on that particular product at all. And so definitely think those are great options. Obviously on the 5-year, you got to lock it up a lot longer than the 2-year. So keep that in mind. Certainly we can take advantage of the high interest rates, which are still available, but we are going to focus definitely more on value stocks, gold, oil, agriculture, all those inflation hedges, which I think will continue to do well. And we are seeing some economic challenges. Obviously the markets had a big pullback, and that's not just the inflation data, it's also what's going on in the Middle East. There's worries about a war breaking out between Israel and Iran, among other geopolitical problems. Of course, Ukraine continues to be a hotspot for geopolitical problems. So those all add up to a challenging environment, but I do not think the stock market is going to have a big drop between now and the election. I think there's going to be a big incentive for the government and the Federal Reserve to do everything they can to keep the markets up for the election. Of course, after the election, all bets are off. So we definitely are going to be taking some more defensive positions as the year and the summer winds on. So look out for some of those changes. And I do plan on getting a market update out sooner rather than later, so you'll get more of these more often. And I do apologize. This one took so long from the last one. We just had a lot going on, and I was out of town, and we were in a position where I had to catch back up and I got back here into town. So feel free to reach out anytime. Happy to chat with you. Happy to sit down with you and go over your accounts. All of our advisors are here ready to meet with you, and I hope to see you in our Mission Valley office very soon.